Hello and welcome to another lesson. So today we're going to be looking at which liquidity to focus on. So we have already outlined why liquidity is relevant in the first place, and today I'm going to break down to you exactly which liquidity you need to focus on, and you need to start back testing and actually journaling. So let's start. So which liquidity do you focus on? So there are three levels of liquidity you need to focus on. So number one, you need to focus on the session highs and lows. You need to focus on the daily highs and lows, and you need to focus on the monthly and weekly highs and lows. So the reason we are focusing on this liquidity is because smart money is focused on this very liquidity also. So we want to trade also in line with what smart money is doing, and by smart money I mean maybe the banks. So this is the liquidity we need to focus on. So let's look at a few examples in the charts of maybe how it looks like. So the first type of liquidity is the session liquidity. So when I talk about session, I'm talking about the session that we taught, that is the Asian session, London session, and the New York session. So in this example, we are seeing that the market was somehow in a consolidation, but we see that the market had accumulated a lot of liquidity here. So you see a lot of flows being accumulated here during the Asian and the London session. So during New York, we are seeing, so from the beginning of New York, we are seeing that the market dropped. Actually, it dropped from this high to intentionally take out these lows, and then immediately we are seeing a reversal and a response from the market. I think there's a news release during this time. So you're seeing immediate reversal. So actually what you want to see, once those lows are taken out, immediately you want to see the market responding. That is how you know that that's the liquidity that you need to focus on, and that is the relevant liquidity that the market is using. So once it takes out those lows, you want to immediately now start seeing immediate response from the market, creating a low and now starting to reverse immediately. So that's how you know that this is the liquidity that the market will focus on. So even before we dropped, we see that there's a high here that was taken out just within the same session of London. We see that the market took out this high, then it dropped lower from that high essentially. Now the other level is the daily highs and lows. So when considering the daily highs and lows, we are looking at the daily chart. This is the Euro USD. So I outlined a few examples here, but there are numerous examples of liquidity being taken out. And the first thing you want to look at, when this high was formed, then the market dropped, it came back up high intentionally to take out this high so that it can continue lower. This period actually we were bearish Euro USD. So actually you see that in effect the market just intentionally went higher in this period just to take out this high, and you actually don't want the market to go very high above the liquidity you're focusing on. So that's another key point in the liquidity you're focusing on. You don't want it to go any higher, just a few pips above this high, and that's enough. You want to see immediate response for the market to start collapsing lower. The same thing we are seeing here. The market just went just a bit higher above that high, and then immediately we're seeing response. Actually this day when it took out, you can see that day, that bullish candle, it took out that high. The very next day we are seeing immediate response, and the market collapsed even lower. So when we got down here, so these were buy side liquidities, that's why we were selling, and then we have sell side liquidity here which was taken out, and immediately we're seeing the market reverse higher. So finally, looking at the monthly highs or lows. So this could also be a weekly chart. So you can go into a weekly chart and look at even more examples. So we are seeing that there was sell side liquidity here which was grabbed, and then the market immediately reversed. So this is the kind of response you want to see when you are focusing on liquidity. So immediately it takes out the low, you want to see it immediately reverse, and then you'll trade this opportunity going higher. So essentially this is the monthly chart. So the amount of time it takes actually to take out this liquidity will be a long time because this is a monthly chart. So if you count these candles, this a few months, even could even be up to an year before we take out this low, and then another year to reverse, and another year to continue. So you see, it takes a lot of time. So but once liquidity is taken out, immediate response, we are seeing the market collapse. Another example of sell side here, it takes out and then it reverses high. So in your exercise, again, you want to go into your charts just as I've outlined, annotate the charts using the 1 hour liquidity. So essentially, once the session liquidity has been taken, be it the session monthly, weekly, daily highs or lows, they have been taken out. You can scroll through maybe the 1 hour, the 15 minutes. So if it's the session, you might want to use the 15 minutes. If it is daily, weekly, monthly, you can use the 1 hour chart to maybe look at once that low is taken out. So you can backtest and see once the low or high is taken out, what happens after that. You'll see actually immediately the market will start reversing in the opposite direction. So thank you so much for watching. See you in the next lesson.